Good day everyone, I am Cristine Ramirez from BSBE 2D and the assigned topic that I'm going to discuss is Chapter 13, which is the principles of deduction. Deductions from gross income. Deductions from gross income pertains to business expenses incurred by the taxpayer engaged in business and engaged in practice of profession. What is business? Business means habitual engagement in commercial activity involving the regular sales of goods and services to customers or clients. In taxation, the term business is generally used to include the exercise of a profession. Self-employment is a business, but employment is not a business. Business expense versus personal expense. Business expense are costs of doing trade, business, or practice of profession such as employee salaries, office utilities, supply and rent, taxes, losses, bad debts, depreciation on business properties, research and development. Personal expense includes the living and the family expenses of individual taxpayers such as family food, personal recreation and transportation, medication, home rental and utilities, tuition fee of dependents, and the other similar expenses. Allocation of common expenses. Expenses that are intended for both the business and the personal use of the taxpayer are allocated between the two. Only those that pertain to business are deductible. Illustration number 1. A taxpayer borrowed money from the bank, used 60% of the proceeds to finance the construction of his house and the remaining 40% as working capital for his business. He later paid 10,000 interest. Bali yung 60% po, i-allocate natin bilang personal expense at yung 40% naman po, i-allocate natin bilang business expense. Illustration number 2. A taxpayer engaged in trading business is renting a 2-story warehouse for 40,000 a month. He used the lower floor to store merchandise and the upper floor for his residence. Bale po yung lower floor, i-allocate natin bilang business expense at yung upper floor naman po, i-allocate natin as his personal expense. Business expense versus capital expenditures. Business expenses benefit only the current accounting period. They are costs of generating income or gains for the current period. Hence, they are deductible against gross income in the current period. Example of business expense: salaries and wages expense, utilities expense such as electricity, telephone, internet, gas, and water, selling expense such as delivery and commission expense, rent, taxes, and permit. Capital expenditures. Capital expenditures are expenses that benefit future accounting period. They are initially as asset upon acquisition, then later deducted against future gross income when used in trade, business, or profession of the taxpayers. The advanced deduction of capital expenditure is not warranted as it contradicts the lifeblood doctrine. Example of capital expenditures: items of property, plant, and equipment, inventory, investment, prepayments, acquisition of intangible assets such as patent or franchise, including cost of defending the same courts, expenses to promote business goodwill, rentals on capital list or finance list that transfers ownerships. Property, plant, and equipment pertains to all types properties used or reserved for use in the business of the taxpayers such as 1. Land use currently intended to use in the business. 2. Depreciable properties. Under depreciable properties, we have land improvements such as fences, benches, and roads, building improvements such as installed escalator and elevators, machineries and equipments, furnitures and fixtures, and leasehold improvements. Depreciable properties pertains to those that decreases in value through normal wear and tear by usage or through obsolescence by the passage of time. Inventory includes merchandise intended for sale. It may also include tools and supplies used by taxpayers in his business. Investments are asset purchase which are intended to earn from appreciation in value or for accrual of income such as dividends and interest. Example of investments: lands held appreciation in value, and stocks, bonds, and other securities of another corporation. Acquisition of intangible properties. The acquisition intangible assets such as patent and franchises constitute capital expenditures that must be amortized or deducted over the period they are expected to be used. Expenses to promote business goodwill. Expenses incurred to create or maintain some form of goodwill for the taxpayer's trade or business or for the industry or profession of which the taxpayer is a member are non-deductible. The term goodwill is used generally to denote the benefit arising from connection and reputation in business. Rental payments on finance lease that transfer ownership. Rentals on a finance lease or capital lease that transfer ownership at the end of the lease term, commonly known as rent-to-own arrangement, are considered expense. The rental constitutes acquisition of the cost-list property that should be initially capitalized. The capitalized loss shall be depreciated throughout the useful life of the property. Rules on deducting capital expenditures. Number 1. Non-depreciable asset. The cost of assets that do not depreciate by wage or by passage of time, such land deducted against the selling price when sold. Number 2. Depreciable properties. The depreciable cost or the acquisition cost net of expected salvage value is allocated as deduction over the useful life of the property. The useful life to be serviceable or its legal life if applicable, whichever is lower. Useful life and depreciation rate. Under Section 34 F3 of the National Internal Revenue Code, the taxpayer and the CIR may enter into a written agreement on the estimated useful life and rate of depreciation of any property. Such agreement shall be binding on both the taxpayer and the government in the absence of facts and circumstances not taken into consideration during the adoption of the agreement. Depreciation methods. The taxpayer may choose from the following methods: straight line method, sum of the year's digit method, declining balance method, 150% or 200%. Other method which may be prescribed by the Secretary of Finance upon recommendation of the Commission of Internal Revenue. Straight line method. The depreciable cost is simply spread equally over the useful life. The annual depreciation expense is computed as acquisition cost less salvage value divided by useful life in years. Illustration. On January 1, 2014, a taxpayer acquired a 6 million peso building with 1 million peso salvage value at the end of its 5-year expected useful life. The computation is, ang acquisition cost po niya ay 6 million, less po natin yung salvage value which is yung 1 million, divided po yung useful years which is yung 5 years. 6 million less 1 million is equal to 5 million divided by 5. Ang annual depreciation expense po niya is 1 million. Sum of the year digit method. The depreciation charge is computed as a fraction of the remaining useful life over the total of the annual remaining useful life of the asset. Illustration. A taxpayer bought a machine for 120,000. The machine is expected to be sold 20,000 net of selling its 4 years estimated useful life. The depreciable cost 100,000 computed as 120,000 less 20,000. Paano po natin makukuha ang divisor? Makukuha po natin ang divisor kung i-add natin ng annual remaining useful life which is yung 4 plus 3 plus 2 plus 1 is equal to 10. Pwede po natin gamitin ang arithmetic series na may formula na n times n plus 1 divided by 2 kung saan papalitan po natin ng n ng useful life which is yung 4 years. So 4 times 4 plus 1 divided by 2 is equal to 10. The depreciation expense for each period is computed based on the depreciable amount as follows. First year, 4 divided by 10 times 100,000, ang depreciation expense po niya ay 40,000. Ang book value at year-end po niya ay 80,000. Paano po nakuha ang 80,000? Gagamitin po natin ng formula na acquisition cost less depreciation expense, which is yung acquisition cost, yun po yung machine na binili ni taxpayer na nagkakahalaga ng 120,000, ililess po natin sa depreciation ng first year, which is yung 40,000, kaya po nakuha ang 80,000. Second year, 3 divided by 10 times 100,000, ang depreciation expense po niya ay 30,000. Ang book value at year-end po niya ay 50,000. Paano po nakuha ang 50,000? Kukunin po natin ng book value at year-end po ng first year, which is yung 80,000. Ililess po natin sa depreciation expense ng second year, which is yung 30,000. Kaya po nakuha ang 50,000. Third year, 2 divided by 10 times 100,000. Ang depreciation expense po niya ay 20,000. Ang book value at year-end po niya ay 30,000. Ganon din po ang gagawin sa third year, which is yung kukunin natin ng book value ng second year, which is yung 50,000, ililess po natin sa 20,000 na depreciation expense ng third year, kaya po nakuha ang 30,000. Fourth year, 1 divided by 10 times 100,000, ang depreciation expense po niya ay 10,000. Ang book value at year-end po niya ay 20,000. Declining balance method. A declining rate not exceeding double of the straight line rate is applied to the book value of the property. For every period, depreciation expense is computed by multiplying the depreciation rate to the declining book value of the property. The salvage value is initially ignored in computing depreciation expense, but is considered in the terminal year of the property. Illustration. In January 2, 2014, a taxpayer purchased an equipment for 500,000 peso, which is estimated to last 5 years with 50,000 salvage value. The taxpayer used the double declining balance method of depreciation. The depreciation rate is computed by multiplying the straight line rate 1/5 by 200% is equal to 40%. The periodic depreciation expense and adjusted tax basis is computed as follows. 2014, 40% times 500,000, ang depreciation expense po niya ay 200,000. Ang year-end adjusted tax basis po niya ay 300,000. Paano po iyon nakuha? Kukunin po natin ang formula na acquisition cost less depreciation expense, which is yung acquisition cost ay yung halaga ng equipment na pinurchase ni taxpayer, which is 500,000. Ililess po natin sa depreciation expense ng 2014, which is yung 200,000, kaya po nakuha ang 300,000. 2015, 40% ita-times po natin sa year-end adjusted tax basis ng 2014, which is yung 300,000, kaya po ang depreciation expense po niya ay 120,000. Ang year-end adjusted tax basis po niya ay 180,000. Paano po iyon nakuha? Kukunin po natin yung year-end adjusted tax basis ng 2014, which is yung 300,000, ililess po natin sa depreciation expense ng 2015, which is yung 120,000, kaya po nakuha ang 180,000. 2016, 40% times 180,000 na year-end adjusted tax basis ng 2015, ang depreciation expense po niya ay 72,000. Ang year-end adjusted tax basis po niya ay 108,000. Paano po iyon nakuha? Kukunin po natin ang 2015 year-end adjusted tax basis na 180,000, ililess po natin sa depreciation expense na 72,000, kaya po nakuha ang 108,000. 2017, 40% times 108,000, ang depreciation expense po niya ay 43,200. Ang year-end adjusted tax basis po niya ay 64,800. Paano po iyon nakuha? Kukunin po natin ng 108,000 na year-end adjusted tax basis ng 2016, ililess po natin sa 42,200 na depreciation expense ng 2017, kaya po nakuha ang 64,800. 2018, kukunin po natin ng year-end year-end adjusted tax basis ng 2017, which is yung 64,800, ililess po natin sa salvage value ng purchase equipment, which is 50,000. Ang depreciation expense po niya ay 14,800. Ang year-end adjusted tax basis po niya ay 50,000. Disposal of the properties before full depreciation. If the property is disposed of before it gets fully depreciated, its book value is deducted against the selling price. The difference is either a gain or a loss. If the property is destroyed, its book value is recognized as an ordinary loss. Intangible asset. Amortizable intangible assets, or those that lost their value over time, should be expensed over the legal life or expected usage life, whichever is lower. Intangible assets that do not lose their value, such as franchise or public utility vehicles, shall not be amortized. Inventory. For goods, inventory, and supplies, their costs are deducted when sold or used in the business using the inventory method of the specific identification method with the aid of point-of-sale machine. Illustration: the inventory method. California Corporation had the following data pertaining to its inventory. Gross purchases, $2,500,000. In-transit freight and insurance, $50,000. Purchase returns and discounts, $100,000. The beginning and ending inventory during the year were $250,000 and $340,000 respectively. Cost of goods sold shall be computed as follows. Beginning inventory, $250,000. Gross purchase, $2,500,000. Add freight in and insurance, $50,000. Less purchase returns and discounts, $100,000. Ang net purchase po niya is $2,450,000. Beginning inventory, $250,000. I-add po natin sa net purchase, which is $2,450,000. Ang total goods available for sale is $2,700,000. Total goods available for sale, $2,700,000, less ending inventory, $340,000. Ang cost of goods sold or cost of goods sale po niya ay $2,360,000. Cost of goods sold shall include the purchase price or cost to produce the merchandise and all expenses directly incurred in taking them to their present location and used. The inventory method is applicable to taxpayers using either cash basis or accrual basis. Note that the expensing purchase cost of inventory or supplies normally does not properly reflect the income of the taxpayers unless the fluctuation in inventory level is immaterial. This may expose the taxpayers to risk or income recomputation and assessment by the CIR. Prepaid expenses. Prepayments are deducted in the future period as they expire as they are used in the business of profession of the taxpayer. The advance deduction of prepayments, if material in amount, will cause significant distortion in the income. Hence, it is not allowed. Illustration: in 2012, Zephyra Inc. paid $300,000 as a 3-year advance rental of the lease of the building to commence 2013 through 2015. To close the lease contract, Zephyra Inc. paid the leasor or lease bonus of $30,000. The $30,000 lease bonus is not an expense, but a prepayments that should be amortized together with the $300,000 prepaid rentals. This should be amortized to $110,000 annual expense from 2013 to 2015. Special consideration with deductions. 1. Property repairs and improvements. 2. Property acquisition related cost. 3. Securities issue cost. 4. Manufacturing expenses. 5. Effect of accounting methods. And 6. Effect of value added tax. Property repairs and improvements. Repairs that significantly increase the value or prolong the useful life of the properties are capital expenditure. The basis of the property are included in the subsequent annual provision for depreciation. If the fair value of the property increases due to repairs, improvements, or additions, the actual cost of the repairs, improvements, or additions should be capitalized not to exceed the appreciation in fair value. If the fair value of the property is not determinable, the excess of the actual repair cost over the tax basis of the property is presumed a capitalizable increase in fair value.